Is inflation now under control? And if so, then why are the equity markets indicating otherwise? Gary Glover is concerned that all the top performing assets right now are the same ones that performed the best in high inflationary periods of the past, being the 1940s and 1970s. Today, he'll cover how to trade this market and what he is currently trading in the portfolio and the research behind his current portfolio positioning. Bit to tackle this morning, Gary, but it's a great one. And I remember when you covered it the first time, it was such eye-opening research that I just wanted to dig it up again and again. So here we are, and good morning.
Yeah, it's a bit freaky, some of that stuff, because you've got precious metals are on fire, you've got energy on fire, you've even got some of these sort of more obscure commodities like, things like cocoa, going crazy here. At the last week or two here, we've seen a lot of the other commodities catch on as well. So really got that commodity basket on fire at the moment. So you go back and look at the 40s and the 70s, that type of market there, when inflation was rampant, that's what was on fire. So it's, to me, I find I'm a little concerned, Chris, just because, if inflation has peaked like a lot of analysts are thinking, then why are all these instruments which normally are on fire in a high inflationary environment, why are they hitting it out of the park at the moment? Is it the last stand for them, or is it a sign that that this we're going to see a re-emergence of inflation again? It's just a concern to me. So I'm not 100% sure which way it's going to roll there, but I just don't think we should be seeing all the markers in a high inflation environment all catching a lot at the moment. That is a concern to me. I mean, just putting all that aside there, if the cost of all those raw goods and items are all going up, then that itself is inflationary. So if you think about it, every commodity, all commodities went higher here. Oil price, iron ore price, gold price, silver, copper, even some of the soft commodities there. If everything's going higher, then we're going to be paying more, which is inflationary pressure as well. So that's not good on its own. So the fact that, and the other thing too, Chris, is that historically, if you go back and look at the 40s and the 70s, the two other high inflationary periods, was that we did have a second kick inflation. So you had that big inflation burst, cools off, and you get a second one there. In the past, central banks have cut rates too quickly, thinking they've got it under control, and then it's come straight back here. So good news is the central banks haven't cut rates here yet, although there's plenty of talk about them doing that. But Powell's is held off doing that because I believe actually he's read the data and looked at what's happened in the past. So he's scared to go too early here because he knows what might come here. So there's plenty of economists in this country who think we should be cutting rates there, who obviously haven't looked at the 40s and 70s, what pain might be more substantial there. It's maybe I'm wrong, Chris, but 2 or 3 years of sort of maybe tougher, having higher rates there and killing inflation sounds like a better deal to me than having maybe 5 or 8 years of high inflationary period where everything costs more and you just have rampant inflation. That just doesn't sound that doesn't sound good. It's not good for stock prices. If you look at high inflationary periods versus low inflation periods, I think the market performs so much stronger. So the market can still go up in those high inflation periods there, but it's hamstrung. It might just sort of match or just slightly exceed the inflation rate. Whereas the low inflation environment, you tend to get bigger returns in equity markets as well. So, from a personal living point of view, from a share market point of view, inflation lower is what we all want to see.
Well, they're the insights that really do help. And for context of those who haven't been watching for years, this report coincides with the time where Gary was also pinpointing to say when he was loading up the market before we go for a run. So that'll be an extra highlight towards the end, and we'll resurface that table so you can go through and really highlight the areas that you're talking about and how they formed in history. So that's a good teaser and taster for what will come. But there is still a portfolio. There are still trades to be placed today, and there are still insights that we want you to share with us about how the indices are moving. And if we look at the US indices, you've got here on the chart, they're all sort of breaking out to the downside of these channels or these wedges, this sort of bandwidth that they've been in, and they're pushing down to the downside with what looks to be a considerable, large, bearish engulfing pattern, large, wide range. How's that looking with the distribution days that you've flagged over the last couple of weeks and months and the behaviour that you expect from here?
Yeah, I mean, you've covered it all there, Chris. Basically, they've all broken below the bottom of the channel. We've had 2 or 3 weeks of distribution days, so we've seen some heavier down days. When the market's been down, we've seen some heavier volumes there, which is what you normally see. You normally sort of see a cluster of 4 or 5 distribution days within a few weeks. That's normally sort of when you sort of see a corrective pattern there. And yeah, this market's been super strong here without much of a correction there. And it has sort of broken through here. So just, you've got all the, you've got the NASDAQ, you've got the S&P and the Dow all broken those channels. So that's all negative for mind here. And they've all got distribution days there. And yeah, so it's been a while since we've had a bit of a pullback as well. So the S&P 500's got the equinox and also 144 cycle as well, just for those people who do look at cycles. That is a bit negative there, hitting that into that top there as well. So yeah, it just tells me here that maybe equities are likely to pull back here. So particularly the US equities as well.
Well, particularly in the US, so that means there's something different with the Aussie. It has been that way for quite some time. And you've noted we've sort of been having a few attempts of trying to get through these highs and eventually getting there. It seems like it's running hot cold. So if I just look at this part of the chart here, the final rally that we've had as we pushed out from under the highs that we tried so many times to get through, I'm seeing good, strong bullish candles and then a bit of stability that you commented on, but sort of like 2 steps up, 1 step back, 2 steps up, 1 step back. How does that fit in with the US, and is it part of the commodities that we have exposure to? What do you see happening here?
Yeah, it's really fascinating. Look at that sort of fourth bar from the end. That was the down week. It was pretty heavy selling came in. And then we saw a rally for the next 2 weeks go to a new high, but the volumes really dropped off. So getting less participation on the way up here. But then we had a down week last week. The volume was slightly heavier, but not a heavy week either. So I know that was Easter week, so a bit shorter. So you got to put that in context there. So 4 days, so probably maybe a little heavier than you think there. But that's sort of slightly negative in that response there, but not, the fact that it's overlapping here and the volumes are sort of not convincing here on the way up there, just probably showing a bit of indecision. I'm actually going to put it down to the fact that maybe commodities are so buoyant here, but they are kind of holding our market up a bit here as well. And yeah, maybe we'll just mess around. It's just been such a messy year for Aussie equities. Obviously, we've underperformed here, but we have been a bit of a laggard too as well. So look, maybe we'll hang around here. Just seeing indecision. I'm not seeing the same bearishness that I'm seeing in the US, but I definitely seeing lack of conviction in that drive as well. As we're getting up here, definitely the volume's tapering off here. So that is showing through indecision there. So I think we might come back here. I think we might even break below that previous high, which normally is a bit negative, but it's been such a choppy, couple of years there. I think it might just maybe we'll come back to 7,400 or something like that, and then bounce from there or something. So I don't see a big drawback for us here, but look, we'll see what happens there. It's just not as clean, a bit messier there. And I'll just put that down to the fact that maybe commodities are pretty buoyant there, and we are pretty heavily laden index with the commodities as well. So maybe that's going to stand us in some in better stead there.
Well, one that you have talked about in the commodity front is S32. We've mentioned it a few times and you've discussed it. You're looking at this one here on the chart. We've got this sort of broadening formation here off the low, and maybe stealing your thunder here, but we've got these excessive higher lows. And how does that relate to what you're talking about with the commodities, the market cycles, and particularly the trade that you've got a 4% holding in?
It's funny, actually. It kind of reminds me of the Livermore speculative chart. If you ever talk about the broadening pattern, they're the 1, 2, 3, 4, 5, and then, can get a big move. So it is a bit of a base there. We've got, 0, 1, 2, 3, sort of, got 2 or 3 high lows building there as well. That's sort of on the weekly, that's come back 2/3 of the range. And we're definitely starting to see some of these commodity complex there. So, some in the S32, there's some different sort of metals in there which have been probably languishing, and then just starting to sort of come to light here as well. So, things like copper and stuff there, which have probably been a bit of a laggard there, are starting to move. And so just starting to see that commodity complex really, show some strength there. So it does look pretty good here, good volume. It's on the weekly, it looks good setup here. The dailies, nice little base here. So, so look, I have, added some of this here. It'll be interesting to see what happens when we hit the top of the band here, something around that 328, 330 level. Maybe we'll have a little bit of a breather there, but the volume's been pretty robust here so far. We're just seeing good signs of a base here. So to me, probably any pullback probably going to be look to add to it. So, but some good signs there. I think people look at IGO as well. But IGO is sort of similar sort of stock there. That's got a big base as well there. It's got a few, it hasn't really gone anywhere, but it has been sort of building a few higher lows as well. So just a few similar names looking a bit similar. S32 has definitely broken out a new high, which is a pretty good sign there.
So that's a good commodity stock to look at. One you've mentioned before as well as Sonic Healthcare, SHL. So we're seeing this down this in the bottom half or bottom third of the chart, but seems to just have, after that sudden move that you spoke about, struggled to get down there, and then it's sort of broke out, false break, quick spring or quick reversal back into the range. What's been the behaviour out of this false break or spring low, and why is that important?
Yeah, look, pretty strong bounce off the low. Hasn't shown too much weakness so far. When the market's pulled back too, it's I've been hoping this one will pull back, so looking to add to it, but it hasn't shown too much weakness so far. So I'm still hoping maybe the market, elements like some of those industrials, the US market might wind back a little bit here. Maybe that'll drag Sonic back here, but it is sort of pretty robust so far. It is a bit of a leader in that sort of segment there as well. So I just think there's some pretty good value here, long term here. Just technically, I love that low there, 50% of that. That last leg down, just really some really strong symmetry. Technically there, and some just good signs of volume accumulation taking place at those lows as well. So I really like the setup here. I'm just hoping that the market will, just grind back a little bit there, give us a chance to sort of get set at a better level.
Well, the next one on your chart is GNC being GrainCorp. Now, possibly another set of successive high lows, but over a different time frame and a very different pattern. Talking about sort of the basing formation. This is kind of like, not quite Davis box, but it is in such a bit of a rectangle or confined in some way.
Yeah.
How important is this movement here?
Yeah, no, just just the fact that you have sort of broken out of that sort of large rectangle there, a few touches either side as well. So definitely a bit of validity on the upper side there. Probably what's most, interesting there is that probably the volume's been pretty firm here the last, 5 or 6 weeks, and probably the only little pause week was probably a down week. And then, been pretty robust there. And again, GrainCorp's still in that sort of, as much as it's sort of soft sort of commodity there, still in the commodity space here. So just interesting there that's sort of setting up, quite positive there. To be honest with Chris, there wasn't a lot of super bullish charts there when I was looking through most of the industrials. I struggled to find too many that looked positive there. So this is sort of one of the few there that I thought was looking pretty strong, and pretty buoyant there and showing some strength in this sort of current market there. So,
some pickings this week.
Yeah, just a bit of relative strength versus the market there. Everything else looked pretty, everything else pretty average to me. So, well, this looked pretty good.
Well, the next one on your list for this week's report's Lendlease LLC, and also down the bottom, but it's how it's behaving at the bottom. That's sort of the critical part. So you're often looking at momentum. You're trading the leaders. You're trading those of the new themes or groups or sectors that are pushing back through, and that's showing with the South 32 and the IGOs and the PLS that you've been trading. But this is at the bottom, and clearly before all of those companies started running, they had to go through some of this basing pattern. So what is it about Lendlease that's catching your eye as you're scanning through these charts and looking for relative performance and opportunity?
Yeah, look, this is definitely probably stock in a segment that we probably shouldn't be looking at. And it has been trending down for a long time. It's been a disappointing stock as well. So probably should be just a total avoid here. But we did see a false break here recently, sort of go to a new low, not follow through. Saw a bit of a bounce there. Saw some volume come in. Didn't see, wouldn't say impulsive move there, but just the fact that it was a marginal new low and not a deep low, that's positive there. But sort of since then, the stock sort of pulled back and dried up here. So, but I don't see this thing's going to shoot the lights out there. But I just thought it was pretty interesting there that we got the false break, and we sort of saw the selling dry up as well. So that's pretty interesting for a stock that's been trending down for a long time. It's sort of, but then I just noticed that there was an activist there, investor, who's gone on the register there and really trying to, give the management and board a bit of a kick up the arse. And yeah, that could sort of disrupt the sort of stock, maybe get, put some pressure on management and board to make some changes here. So, yeah, just pretty interesting. It's also, for me, just was one that sort of technically caught the eye. A few fundamentals sort of shifting out there as well. So I thought, well, that's pretty interesting. Yeah, so just probably one for me just to put on the radar and see if this can sort of show a little bit more strength there. But, the last 2 or 3 weeks there, that little pullback there, just didn't see any selling at all, just dried up there. So coming after a false break as well. So, yeah, I'm not in love with this one here. Definitely a strong downtrend. No, hasn't broken a swing high here yet, but just starting to see some resemblance there of maybe a change in character there. So one to sort of put on the radar there and keep a close eye there. It's definitely, if some big changes were to occur there, yeah, we could see some movement there. So it kind of reminds me a little bit of Ramsay Healthcare. And so Ramsay sort of come off, got a bit big, too heavy. And Ramsay has sort of made a few changes, started to sell a few assets there, just starting to make some changes there. And then the market's sort of warm into that. So, if Lendlease starts to make some changes there, that can definitely one to sort of keep an eye on.
All right. Well, if it's not one that you're trading, it's a handy insight to see how you assess an underperforming stock in a chart to see whether the tides may be turning for it. So clearly it's not on the outperformance, not on the relative strength, the precursory things that you look for as you're scanning markets. And maybe it does turn out to be something a little bit like PLS where it breaks out of that bottom. Now, PLS has had that breakout and sort of went through that congestion page, shot the lights out and then pulled back and did that with a bit more sort of compression as it came to where it is now. So as it's had that explosive movement and then seemingly sort of wound down the volatility of sorts to a bit of a compression and coil, how do you interpret that chart and what stands out to you to be a marker of whether you're traded or not?
Yes, I mean, I was actually just reading a Stan Weinstein quote here this morning there. There's an old saying among technicians, the bigger the base, the bigger the move. Always be on the lookout for a breakout from a very large base formation there. And you can sort of see here, we've got a, first high low, it's had a bit of a run, come back quite deep, made us, at first high low. And since then it's been building high low, high low, high low. Had another run here and now pulled back in a bit of a, another wedge again and another higher low here. So this is really starting to base here, Chris. There's, a lot of basing characteristics sort of setting up here. Had some good volume on those drives and also some good volume coming in the low. look at that pullback, the last pullback here, how the volume just dried up as well. So a little bit of selling off the peak here, but then not much selling through on the pullback here as well. So probably like to see, I see today we've actually gapped up a little bit. But today I'd love to sort of see a little swing high broken. Maybe I think that swing high might be something like 392, and see some big volume come in as well. So if we sort of see a nice high conviction bar, some big volume come in there, and we maybe close above 392, above the little swing high there, that'll be a pretty good sign for me. So it looks like a nice base here. It looks very constructive. And I say, look, we know that at the moment commodities, they're all catching a light here. So definitely the sector to be looking in as far as, in terms of what we're sort of seeing in the market there. Again, another, Weinstein comment there, basically, I think the returns are like 2 to 1 if you're trading the sector which is showing strength versus a sector which is showing weakness. I know at the moment you could probably argue that lithium is weak, and obviously gold and energy is strong here, but I still think that commodities segment as a whole there is pretty firm basket, like a maybe bigger basket. So definitely seeing a lot of strength in that and the whole commodities complex there. So to me, that's a segment or a sector that we should be looking at there at the moment, just because we're seeing so many of those commodities catching a light here.
Well, that's just such an insight, because you cover that on the other part of the weekly updates where you look at those leading sectors and themes, and that's where you're identifying the opportunities. But we looked through market and sort of round out this report. You've got another one in here, Cettire. Well, the chart kind of says it's not leading at the moment. What's caught your eye on this chart?
Look, this caught my eye a few weeks ago. I was going to put it in a few weeks ago. I thought, no, it doesn't, people just want to know what goes up. They don't really want to know what goes down. But I thought, look, maybe people are going to keep an eye on this stock, want to trade and stuff there. But this one is, to me, this is showing some really scary characteristics from the past there. And what I mean by that is that, it's had a nice sort of pullback off the top here. Some people might be thinking, this, obviously a pretty strong high momentum stock here, but been a pretty good performer. Maybe I'll look to sort of come back in. To me, it's showing some of the more scary characteristics I've seen actually for quite a while here. Always wary of these high momentum stocks that have had these cracking runs, ones that have had big corrections in the past, Chris. Because oftentimes when they sort of have the big correction, go back up and go to a marginal new high, normally that means you're going to come back and retest the last low, which sounds unfathomable. I've learned these false breaks here sometimes, usually sort of on the daily and weekly. They're smaller sort of setups. They don't sort of have big ones. I've seen a few of these setups in the past, and I looked at them early and thought, there's no way it can get back down there. Surely not. And I saw the S&P 500 do the same thing there. Well, geez, I'm trying to think, just before the GNC. And I thought, surely S&P can't pull back 50%. No way, But I've seen a few stocks over the years do exactly this. A few indices, I thought, just kind of quite scary here, On its own here, just the last few, if you look at the daily and the weekly there, you've seen that some pretty heavy sellings come in there on the back of that sort of that weekly move down, and the last week moves down as well. So showing some heavier, scary type selling here compared to, look at the whole move. Those are, there's probably 2 or 3 of the biggest down weeks here the whole year, or the whole, basically for the last 4 or 5 years. So there's just quite a lot of negativity there for me on this chart there. And at the moment, I think there's a few concerns around where they're paying tax and stuff there in the model. And so there's a little bit of noise out there on that. They could be up to no. I'm just doing a few things on the slide here, which aren't good. So there's a little bit of negativity there, fundamentals at the moment, but the price action is pretty negative to me, pretty scary. So, me personally, I wouldn't be trying to buy on the dips there, based on what I'm seeing here. It's just, it's got a lot of, it's got a lot of characters saying that this thing could really have a pretty heavy sort of sell-off here. So I know it's already had a sell-off already. It seems pretty large already, but from what I've seen in the past there, that might just be the start of a bigger sell-off, Chris. So I guess I'm just advising everyone, probably, to me, that's an avoid totally at the moment.
Well, that's a cheap can get cheaper, and one that you quoted before, I think might have been Mike Winavini, which is, correct me if I'm wrong, I think it's 50% of stocks fall, 80% of stocks will fall 50%.
Yeah. Yeah, so 80% of your best growth stocks will fall 50%. I have the corrective. Then, 50% will fall 80%. So, yeah, and it's already done that already once before. Why can't it do it again? So, why did it get buried so much last time?
Yeah. So
just got to be careful of that. It's sort of, that's just a pretty, for everything I know about charts and growth stocks and price action stuff there, that's looking, that really is quite concerning to me. So, if you were long now, I'd make sure you have some sort of stop in here. This one looks pretty scary to me.
Well, that's good to understand what would you avoid, especially if we're talking about high momentum and making 52-week highs on new highs, what behavior you like to avoid or would prefer to avoid. That sort of will now come back to where we started the conversation, which is looking at the inflationary environment and understanding how and why you're positioning the portfolio the way that you are because of the research that you've done about the 40s and 70s. And we will come back and I'll flick over to the report that you wrote in October 2022. And I won't steal your thunder by reading what you've got in the report. But for the context, as I flick over to this report, this is the table that we're going to. But for those of you who haven't been following Gary for years, this is the 17th of October 2022. And we'll just quickly look at his charts because it's pretty obvious what he's looking for here. These were the points where he was saying, look, turning point to the market, but he was really pointing to the October portion is where he was going to load up. And you just need to go back through in history and have a look to see how those markets have performed. So look, take your time, pause the video, have a read of his report, but we just really put that into the context of when you started using this research to help you construct the portfolios and redirect them. So there's all the inflation prints and numbers that you'll probably talk about in a second. And I'll just leave them here for a second so people can freeze frame if they want to read it.
Yeah, I didn't really sort of put them in there to give myself a plug there.
Oh, no, you didn't. It's just why I'm doing it. You never do.
Yeah. But I know that, look, to be honest, Chris, the midterm year, the 60-year cycle, all the cycles were just aligned in 22. It was in terms of, anyone who follows cycles could have seen that obvious there. And I think we showed like every 4-year cycle. Remember that little period there, like that October, I think maybe a couple months either side there. But, every 4 years, you can go back. I mean, anyone can go back and just put a cycle on 4 years, October midterm year. Just look at that. Go back and look at 50 years. It's a laid out mosaic. It's the way I look at it. The cycles this year haven't been quite as, haven't been as clean, a little bit trickier this year. We basically were looking for maybe a bit of a bounce and maybe a bit choppy to the sort of from maybe sort of late February, March there, which hasn't happened really. It's been quite strong here. So this has sort of done a little different cycle there. I think only the 60-year cycle is the only one that's been this strong, Chris, out of all the other cycles running this year. So most election years have a bit of a cool off at some point. Most of the 10-year patterns as well have a cool off there. So I think only one out of like the last 100 years has actually run pretty hard. That's a 60-year cycle. So that's what we're sort of kind of following here at the moment. But what's more interesting in this report is that table and also the 40s and 70s charts. You look at that table there. It shows you what asset classes performed well in the high inflation environment. So we know energy just hit it out of the park. We know precious metals hit it out of the park. We know commodities in general were very strong. Value shares were pretty strong as well. But we know small caps kind of growth less strong. And just some of those segments there, just it's just interesting here that you look at the 40s and 70s, they're pretty scary markets. If you look at those in detail there, you can see some really big up years and some really big down years. I mean, we highlighted basically in the first coming out of the first deep pullback. Obviously, most of those sort of when inflation first arrived, we had a pretty deep pullback, and then we had a really strong gain, and then after that we had some decent pullbacks there, probably smaller, but still extreme volatility, Chris, as well. Some really, really big moves there. So in the 70s, that's probably the one to have a look at there. That's sort of the role model for high inflation environment. Got to remember there we had, I think inflation was 11, 9, 5.7, 6, 7, 11, 13, 10, 9. Geez, that's the stuff that we want to avoid here. That's we do not want to be going through that type of thing again, right?
Inflation, that's huge.
No, it's just not good for everyone. It's just a tougher environment to exist in. If people think they got pressures now, cost of living pressures, imagine going through a decade of that. I mean, Christ, that's
double what we're going through in some of those years.
Yeah. So I mean, that's why I'm a little concerned that some of the things we're seeing here is that we're seeing that we're finally seeing precious metals finally come to the fore. Energy, obviously, we know has some big moves in those periods, but it's sort of like, I guess the only good thing is the Nasdaq has been pretty strong there, where it probably wasn't in the past there, but I think business has sort of changed a bit here. In that the Nasdaq businesses there, they can run a bit lighter. They don't have the same sort of costs that what other businesses have. So they're probably not wearing the cost line. But so just maybe evolution there is where it changed them a little bit there, but everything else is pretty similar in terms of what we're seeing there. So just concerns me a little bit. And if you look at those sort of 40s and 70s charts again, they just highlight how volatile those periods can be. You just don't want to, we really want to avoid those sort of big up and down swings. So, when I looked at the 40s and 70s, I was just seeing these sort of like, these 70% rallies and these like 30, 40% declines. I thought, Jesus, how hard that is. That's a tough environment there where up and down, up and down, up and down, some big moves, some big rallies, and some pretty sharp, nasty falls there. That's just the type of environment sort of probably scare investors a bit as well. And you're seeing things, just things like the banks at the moment. The banks don't make any sense to me. The fact that, I think CBA is the most overvalued bank in the world. Got no growth forecasts for the next couple of years. Just trading at 29 times. So, but that, if you look at back, again, historically, people overpaid for the high yielding value shares because they got paid to hold them. So again, that fits in line with what was going on in these high inflation periods of the past. People overpaid for these high dividend shares because they got paid. So, but if you look at those markets, they had some big moves up and big moves down. So definitely saw some volatility in those markets there. So that's a concern here to me, is that we're seeing all these commodities catching a light here at the moment. And that is not what we should be seeing if inflation is peaked, Chris. So,
yes, that's the key message, isn't it? Is what you're seeing in the market at the moment. The leading shares, the ones that are shooting the lights out on your portfolio, the ones that are showing the greatest opportunity percentage return right now, are fitting with, hang on a second, these big returns are happening with the big inflationary years. That's not a good thing. That's a precursor to bad times of bad inflationary environment, whether it's 1 or 2 years ahead. Is that kind of what history is telling us about when this part of the market lighting up in an overarching inflationary environment?
Yeah, the concern there, I guess probably the Nasdaq is probably the only exception there, but that's, the Nasdaq, that's probably the one area to be concerned about at the moment. is probably that's I think we were talking about precious metals there, maybe 6 to 9 months ago. So that was the only one that hadn't sort of played ball, and then now it's suddenly playing ball here. So the Nasdaq might be the only exception here. It's probably outperformed normal there. So that is probably going to be, it might be a little bit. I think they've changed a little bit. Nasdaq, those companies do run a bit lighter there. The cost structure there is probably going to be less there, but does still, it'll put a lot of pressure on small caps still. So to me, that's still a void. I know everyone's on TV every week for the last 6 months, 9 months saying small cap. So they've underperformed. But Chris, you and I know that relative strength, the stocks that are the strongest ones, they're the ones you've got to stay with. The ones that are making 52-week lows, they stay there for a long, long time. So, so to me, small caps are still too scary environment to me. Small caps are when inflation's gone. At this stage, inflation hasn't gone, and the market is not trading like inflation's gone. It's actually trading the opposite at the moment. So that's a concern. So I don't know, maybe everything's just running here maybe all these things are all running here because we're at the end of this cycle. That's what we all want to hope for, because then if inflation does eventually maybe disappear by the end of the year, we can get back to normal, get some stronger equity returns there. But there's to me, I'm just seeing some alarming signs there, based on in the market at the moment. So which is not good for inflation there. So I don't know how people can talk about deflation here at the moment. That's
we're a while to go till we've got that.
It's so far away from that, it doesn't make any sense to me. So we just have to get it. History tells us that we have to do everything to get inflation under control. We have to put our foot down on inflation, and we have to hold our foot down on inflation until it has gone completely, and then we can get back to normal. We can't, we don't do that. But the economy, the market, business is not going to sort of thrive. We're going to have issues. So, everyone else can, other economists have got other ideas around this. It doesn't make any sense to me, but history tells us that's what we're going to do. So hopefully central banks do that. Chris, so far they have done that. But I'm worried about sort of, a lot of pressure around cutting rates here at the moment, before inflation is really got under control here. And I view that as a bit of concern here. So, fingers crossed, we can get inflation under control. Equity markets can have some better years ahead here. But as we're seeing, when I highlighted this in October 22, those numbers there, the return on equity for value shares and for some of those sectors was still pretty buoyant, even though you've got high inflation. So markets can still do reasonably well. You just have to be in the right areas. So that's the key.
Well, that is the key. That's absolutely right. And for clarity, we should say that you're not anti-small caps. You'll work with them. They just need to show their relative strength and prove to you from a technical perspective that that's the place to invest. So you'll happily switch to it. Am I right? That you're not completely anti.
No, look, if conditions change, just that's the hard segment here at the moment. That's, the conditions, the environment here is telling us that's been telling us since October 22, that's the segment to probably not be invested in. So since October 22, basically, we should have been invested in energy, precious metals, value shares, high dividend sort of stocks there. And to be honest, all those segments have done pretty well.
Yeah.
I mean, the only thing there is sort of NASDAQ there, that did sort of it was a bit of a laggard there initially, but it has got going here. So to be honest there, when inflation started to really start to come off, we saw some of those growth stocks really take off there. So that's when I did actually sort of start to play some of those. But so we really need to see inflation keep cooling off here, Chris, in order for those NASDAQ high growth stocks to sort of play ball here. So that, to me at the moment, the greatest risk here is that if inflation doesn't cool or doesn't sort of cool off enough, then probably the Nasdaq is probably the greatest at risk.
That unfortunately is what's in front of it, but hopefully we don't see it. So as you said, sort of the fingers crossed. But this is the eligible thing that we need to do to have the right positioning or the best positioning for our portfolios is this kind of research where you understand what has happened in the markets before. And to that extent, we do say thank you very much for doing the research and refreshing the research, digging back up and giving it to us in this current context of what the market is doing right now. We say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
Gary's talked about inflation right here and other setups. There's a whole playlist of where Gary covers them in more detail. And then also a whole playlist of what Gary talks about when we're doing the Thursday or Friday recordings of talking about the leading market momentums, the launchpad, and those companies that are coming to the forefront with the relative strength. Also on the left is his Twitter or his X handle if you want to follow him there.